Hello everybody, it's Tom Sheridan and I have a special guest with me today to present to you the Q4 Global Market Update from 7 Investment Management. My special guest is Terence Moll. Terence is our new Chief Investment Strategist for 7IM. He's had a long and distinguished career in investing in multi-asset portfolios. Terence, quickly tell us a little bit about that career.
Thanks, Tom. From the beginning, when I began talking to 7IM a few months ago, I felt that there was a certain intellectual affinity, a certain similarity in the way that we thought about the world and about investing. So I'm absolutely delighted to be here with you.
Now look, if we are looking at the world as a whole, both economies and markets, give me a quick summary of what comes to your mind right now.
Yes, the way that I describe the world right now is as a nervous Goldilocks. Global growth is strong. We could well be just over 3.5% this year. Global inflation is drifting up but is firmly under control. And so the world economy is neither too hot nor too cold, but it's in the middle somewhere. It's in the Goldilocks state for the time being.
Okay. Now, you mentioned in there that we're seeing a bit of inflation, but I didn't hear rampant inflation from you. And that's very, very important for our view, because one of the things that we have been worried about is, are we going to see inflation that gets carried away, drives interest rates up, drives the dollar up, causes emerging markets mayhem, blah, 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 blah. That's not the scenario that you're painting.
Very much not. We think inflation will continue to drift up for a while, but in places like the US, which is incredibly important for financial markets, inflation is currently about 2.5%. We don't think it's going to get to 3%. And so in the core developed markets, inflation drifting up, bond rates will drift up, but will certainly not surge.
Okay. So I thought I heard you say that Goldilocks was a little nervous. Yeah? She got a couple of bears chasing her.
Not this time. Yes, the reason that I described it as a nervous Goldilocks is we think that there's far too much debt in the world, especially debt in US dollars. And as US rates rise and if the dollar remains strong, we think lots of borrowers will really struggle to service this debt. And we think it's a danger factor for financial markets.
Okay. And there would be implications for all asset classes if that were the case, the most obvious ones being in fixed income. But let's talk about equities for a moment. Valuations, earnings, what's the global picture on equities?
I think the global picture, starting with earnings, is that we've had a period of strong earnings growth for about the last 12 to 18 months, particularly in the US. Earnings are now beginning to come off a bit, but will still remain positive. In terms of valuations, US market expensive by historical standards, but supported by very strong earnings. Earnings growth in Europe has also been strong. In Asia, not quite as strong, but still firmly positive. So the earnings picture has been about the healthiest that we've seen for about 12 years.
So if that's the broad picture on fixed income and on equities, let's talk particularly about how it is that we're positioned. And start with equities, if you don't mind.
Yes, in terms of equities, we are slightly overweight equities overall. And the favored markets at the moment are the United States, Europe, and Japan. US because of strong earnings growth, not completely in the price, and Europe and Japan because they are relatively inexpensive by long-term standards.
Okay, so in essence, in the US, we've got a growth play, and in Europe and in Japan, we've got a value play.
Yeah.
Okay, fixed income. What does our fixed income positioning look like right now? Are we overweight or underweight?
Fixed income, we are generally underweight.
Okay, and a little bit about that underweight.
Some of the underweight is in government bonds, where we're slightly underweight. By far the biggest underweight is in credit. Because I mentioned earlier that there's too much debt in the world, there will be debtors who can't repay. And if you invest in, for instance, US investment grade or high yield companies, we think you aren't getting paid enough to take on the risk that they could default.
So even though rates we don't see zooming up, the fact that they will drift up still makes fixed income not the most attractive place for us. So with the money that we would normally put in the rest of the fixed income allocation, are we staying with the alternatives that we've had for the last year or so?
I wouldn't say that we are wildly enthusiastic about alternatives, but we think that alternatives will be up a bit in the next 6 to 12 months, whereas we'd expect most forms of fixed income to be level to down in the next year or so.
Fair enough. And cash?
Slight overweight, waiting for opportunities.
Okay. Now, we've gotten this far in the conversation without mentioning the dreaded Brexit. But of course, since our investors are sterling-denominated investors, we have to talk about Brexit. What is the current thinking about what's going on, and in particular how it will impact the portfolios?
Yes, I think our central case is that the UK and Europe will reach some kind of negotiated agreement, which is what the market is expecting. And if that happened, we'd expect nothing much to materialize. No great surprises in the markets. There's the possibility of a hard exit, which looks increasingly likely at the moment.
Yeah.
And in that case, we'd expect sterling to fall quite sharply. And in that case, our portfolios would do very well because we have a significant exposure to non-sterling assets.
And what happens if we get a pleasant surprise or a soft Brexit beyond what is telegraphed in the current political landscape? What would happen to the portfolios then?
Now, in that case, the most likely outcome is that sterling would bounce and our portfolios would definitely be hit. Now, we're exploring various ways of protecting our portfolios against this. We have some in the portfolios at the moment, and we're exploring some more.
And what kind of a time frame do we have before we actually need to do something there?
Most likely, if that kind of a highly favorable outcome materialized, it would only be in February or even March next year. So we've got some time to put our strategies in place before then.
Okay. So if you were to try to give people a summary of our overall positioning, how would you describe that?
I think it would be stay invested, but don't be too aggressive about it.
And after 10 years of equity markets going up, that feels right to me. Terence, thank you very much. Welcome to the team. We look forward to having you back here next quarter. And thank you again for all of your support, and we'll see you then as well. Thanks very much.